Hey, what's up, guys? Welcome to Accounting with Karim. As always, before we start, honesty and integrity build credibility. For this video, we are continuing with the merchandise operation, but we're just looking today at presentation and some ratios, right? So let's have a look right now. So the first thing we're looking at is whenever we present inventory on the balance sheet, we always have to present it at lower of cost and market. And what does that mean? It means that we cannot present our inventory above how much we can sell it for, right? So, for example, if I made a purchase for $700, at the end of the accounting period, I realized that I can only sell this item for 500. I need to write it down to 500. So I would have to debit my cost of goods sold for 200 and credit my inventory for 200. So that is a write down. So that's what that means to be lower of cost and market, right? So let's look at some ratios now. We have the inventory turnover. So the inventory turnover ratio is allowing us to see how efficient are we in handling our inventory, right? We're looking at efficiency here. So the ratio is the cost of goods sold divided by average inventory. And so a point I want to make here is that whenever we're doing a ratio that has an income statement item and a balance sheet item, we always have to average the item on the balance sheet. So we need to get the beginning inventory plus ending inventory divided by 2. And that amount divided by the cost of goods sold would give us 3.58. So the inventory turnover ratio would be 3.58. On a standalone basis, is that a good number? It's hard to say. When it comes to ratio, we always have to compare, we always have to have comparables. We need to compare it to how we did yesterday compared to how we're doing today. And also we need to compare how we're doing today with everyone else. So we need to compare this number to the industry standard as well. The next ratio we have is days sales inventory. And so this ratio is analyzing how long do we keep inventory in stock, right? So to calculate this is the number of days in the year divided by inventory turnover. So it's 365 divided by 3.58, and that would give us 102 days. And so again, is 102 days a good number? Again, you need comparables. You need to compare this to the industry standard and to the prior accounting period. The next ratio we have is a gross profit margin ratio and or percentage. So how do we get our gross profit? So gross profit is net sales minus the cost of goods sold. That will give you your gross profit. And so for this example, gross profit is 1,300 and our net sale is 2,000. And that will give us 65%. The next one we have is the profit margin, which is net income divided by net sales. And again, your net income is your gross profit minus your operating expenses. And so net profit is $500 and our net sale is 2,000. And we get 25% for gross profit margin. Again, is that a good number? On a standalone basis, it's hard to say. We always have to compare to the prior accounting period and also to the industry standard. Personally, I think the 25% is not a bad percentage for a profit margin because you covered your cost of goods sold and you covered your operating expenses. You will have to pay taxes on that 25%. And I think the rest is for the owner. You're making a profit. And so that's not a bad percentage. But to find out how good this is, you always have to compare it to your industry standard and the prior accounting period. That's it for this video, guys. As always, before we wrap it up, honesty and integrity builds credibility. Until next time, I will see you guys. Cheers.